You're listening to the Pursuing Alpha podcast, hosted by Charles Brandon Snyder.
Anthony Forster, man, I appreciate you coming on.
Yes, sir. Glad to be here.
It's great, man. I kind of hoodwinked you into coming today, so under false pretenses. So forgive me, but I've been trying to get you on for a couple weeks to a month now, and so I think it's gonna be a lot of fun. So hey, do me a favor, and tell me kind of what you do, who you are.
Well, I am a senior VP at a community bank called People's Bank, and I've been with them 16 years. I kind of do a little bit of everything. I kind of cut my teeth on agricultural loans, but also do consumer, commercial, even some residential stuff too, to a point. So kind of do a little bit of everything.
Yeah, and there's a lot to dive in with you, and I could not tell you this is going to be a great podcast because of the current events that we're in with that major bank in California that just failed in the last 3 weeks. Mm-hmm. 3 days. This is going to be it. So first, to get it out of the gate, right? Community banks do not have the same exposures that these regional banks do they?
Well, just the ones that have failed, they're in different markets that they've got different risks than what your community banks have, and that's why it's good to know your banker and have a good sense for who you bank with. And most community banks, they have good, strong relationships with their customers.
But y'all aren't taking the risk that, y'all aren't buying 30-year treasuries on $186 billion like that bank did.
What they do and what we do, it's completely different. You're looking at definitely apples and oranges, or something even further than that than what we do. Yeah.
So a community bank is, let's define that for a second. It's completely different than what a regional national bank is. And the way I always look at it is I like banking with community banks as much as I possibly can because it is owned by the community. Like, it's mainly people that are in the banking industry, or they're actually clients that actually have equity inside of your bank. Is that how that works?
Well, absolutely, but also what I would stress too is we kind of stay within our market and what we know and the things that we feel comfortable within our market to loan money on and build relationships on and those kind of things. And I think that's very important, of knowing who your customers are, what kind of businesses that you're familiar with, that you understand, and that's kind of what a community bank typically does. Yes.
And when you say it's your market, you're talking about there's expertise within any community bank. And I've found this out the hard way. Like, there is expertise within every community bank that says some of them like oil and gas, some of them don't.
Right.
Some of them, like you said, like ag, especially here in West Texas, some of them don't.
Sure.
So it's very specific on the industry that y'all lend to, which I think the consumer doesn't understand that they have to have good banking relationships that are specific to the industry that they're in.
Well, for sure. And so let me give you just an example on an ag topic. Where I'm at, I'm in one of the biggest cotton patches there is in the U.S. And so with that's something that we understand. And so when it comes to a cotton farmer that's going to go out there and do his operation, we know the jargon. We know what he's talking about. Now, if a guy came in that was going to go rice or something like that I have no idea about, that's not something that I'm interested in doing, just because I don't have the expertise and understand it, and I would be doing him a disservice by being his banker.
That's a good way to frame that. That really is. And it's hard to understand that because I get frustrated. And me being a financial planner is I always get those questions from clients like, how does this work? What do I need to know with bankers? Right. And I always, especially with you, and we got to go back here a little bit. Like, we've known each other for the better part of 25 years. We went to high school together.
Yes.
So you're from Shallowater, Texas. I'm from Shallowater, Texas. I love to say this now, a few years older than me, right? Yeah. But you got a hell of a lot better hairline, which pisses me off. I don't even see any gray in there. I got more gray in my beard than you do in your entire body.
Yeah. I don't know how. I feel like I've aged quicker than I've needed to, but no, I still have a full head of hair and not as many grays, but they're coming. I see them coming.
Yeah, and you got 5 kids or 4?
Yeah, I've got 5.
5. I always screw that up, but it's 5 kids. So you're running around with your head cut off.
Well, they're all getting older now and out of the house, so it's becoming more of a challenge to figure out what me and my wife are going to do going forward now. But I imagine we'll find something. We enjoy playing golf and doing things like that together. So.
And she's in banking too, though.
Well, yeah,
indirectly.
Indirectly. She's more into marketing, and so she does that for a financial institution in. But we don't talk banking at home. It's never something that we discuss.
I don't think very many married couples talk banking at home. It's not a subject that you really love to do, is it?
After 5 o'clock, you're ready to talk about something different, just to kind of rest your brain a little bit and the things that you've been doing all day. So start again the next day. But anyway, yeah, it's been a good time. We've enjoyed it, and we've been blessed, so we can't really complain on that either.
So dive back into it for a second. So a community bank is a local owned bank typically, right? With its own shareholders, usually the community around it, and you specialize in whatever the bank knows.
Yes, right? That's correct. And so and you hire lenders and personnel that understand that market too. I mean, you're going to hire those kind of people that can you want to build people around you that know the same kind of stuff that you know. That way, you're stronger than just yourself.
So I know a lot of this because over the last week I've had to do a ridiculous amount of research when that California bank defaulted, right? So the way they defaulted, that's pretty public right now, is they bought long-term treasuries. They had $187 billion in deposits. They went from $86 billion to $187 billion, which is crazy. Some over $100 billion in deposits within 1 year. And so let's speak on that first. Like, deposits matter with y'all. Like, nobody understands, like, the deposits to the banks actually increase your lending limits, right?
Yes.
Can you kind of explain how that works?
Well, and that's not something that I deal with every day, but yes, you're exactly right. So, because what a bank does is they get deposits and they loan them back out. I mean, that's how we make our money. We pay somebody for their deposits, and then we turn around and we're basically going to mark it up based on risk, and we're going to loan it back out to people depending on what the loan request is. So, yeah.
So let's put this in a real world example. So a business comes in, makes a deposit of $1 million, and they average withdraw $500,000 on a monthly basis, but they have that spread that's in there that they usually don't dip down to, right? And you're able to strategically lend off of some of those deposits, but you also lend off of the Federal Reserve, right?
You do get Fed funds, yeah. If you need to bridge a gap, or if you don't have the deposits available, then yeah, you're going to buy Fed funds. And again, that's not 100% my department to really speak real knowledgeably on, but that's in a sense the way that deal works. And so, yeah, they'll keep an average monthly balance in that account, and so you kind of know after several months how much they're going to keep in that account, and that kind of tells our guys how much.
Y'all can lend off of that.
Well, yeah, and if it's a transaction account, those are harder to gauge. Now, whenever you get
CDs
is one. Yeah, I mean, that's obviously kind of a core deposit there that is going to be there for a certain period of time, and those kind of things. And so it's easier for us to gauge that. But we always have funds available through Fed funds and things like that if we see that there's a shortfall. Now, we haven't had that issue at the bank that I'm with. So.
Yeah, there's no issue at your bank. In fact, my biggest complaint with your bank is too conservative. But that's a good thing, and that's where you want to be with great banks that are conservative, because they have their shareholders, they have their people in mind. There's not going to be a run on the bank that we just saw in California.
Yeah,
right?
Well, we sure hope not, and that's something that I agree with you. We try to do things right every day, and so when we do that, we may come off as being conservative, but you know what? At the end of the day, we're typically a shining star, and so that's something that I've always wanted to be part of, and so I'm thankful that I've been there.
Yeah, you've been there a long time, man. That's it's good. It's I love how I've seen your branch grow, and what you've done has been awesome. But so if you're lending out, and so the bank makes money on the spreads of whatever they're borrowing from the Fed and borrowing from their actual consumers to lend to a loan. And they mark that up, and the spread difference is how the bank makes money, but it's also how they provide expansion in our economy to be able to grow locally.
Sure.
Right.
And we have expenses too, obviously. That
Of
we
course,
take
you
out
got
of
your
that.
payroll, you got the building's payroll. I mean, right.
And
So
you have that plus
overhead.
plus what you want to profit or try to profit, and so that's one of those things that you look at. So as you're taking in deposits and you're quoting rates on those, you got to know that you got to turn around and loan that back out at a certain percentage too to make the things work on our end. I mean, we're running a business too, just like other people.
Yeah, and I think a lot of consumers don't understand that. So let's. I appreciate you kind of giving the basic of how banks work, because I have so many questions from just general personal financial planners, of small business owners that just get started in business.
Yeah.
Right. And I think that's the hardest thing is you get started in business and you hit this. You got a good business, you're selling a product, but it's always liquidity becomes an issue, right? And so you need to have a good banking relationship so they can expand that sales. They can expand that because you're going to need to add on some debt if your business is growing really well, right? But you also have the real estate arm that if your business is doing really well, you're going to have to take a real estate loan out typically, right? And so there's all these aspects into it, from C&I lending is, right, general cash flow lending that you might need a line of credit, right? And there's a lot of things on that aspect. Then you have the real estate arm. So let's break that down, and then I want to kind of dive into what is the pitfalls of it, because I think if people would understand the pitfalls of lending and what the hurdles are, it would be so much cleaner. Like a lot of people don't understand from a business asset, debt to service coverage ratio, right? That's the biggest one we talk about, debt to income ratios, things like that. If they understand those 2% degrees going into a loan, I think it would make the banking industry a lot easier and more transparent, but it also make the consumer manage their money inside of their business a little bit different. And I think that our podcast is really gearing to that aspect of it. So rewind that for a second, right? So when you're looking at different types of loans, is there different equations? Is there different things you need to consider for a consumer standpoint of, hey, what kind of loan do I need? How do I build a relationship with a bank? Because I would say that's the hardest thing too is, a guy walks off the street and says, I want to build a banking relationship with you. That's a slow process. It's not like you're close to the opportunity, but you're a little more gun shy, I would say.
So you mentioned, do you want me to talk on consumer lending, or you want me to talk about commercial lending?
Where do you want to go with it?
Well, I don't know. You mentioned
both those sides. Yeah, let's start with consumer, because I think that's more general.
Yeah, I mean it's the people that are buying the boats and the cars and the
houses.
Houses too. I mean that's not something I specialize in. We have a mortgage department that handles that. But it's kind of the everyday guy that buys the things that they need, toys, things that they want to provide for their family, cars, that kind of stuff, and those are all going to vary. And like you mentioned earlier, you said debt to income. That's one thing that we look at. So you take a consumer's debt, and you take their income on a monthly basis.
When you say debt, though, you're referring to the debt payment, not actually the debt.
Yes, well, correct. That you take the payment plus what you break down their income over 12 months, and so to keep it simple, let's say somebody made $12,000 a year, so every month they're making $1,000, and then you would look at what actual installment loans that they have. And when we talk about debt, we're not talking about, and I've had this question asked by a lot of consumers, well, I've got an electric bill or I've got a phone bill. Well, those don't include in your debt to income ratio. It's stuff that every month you're going to pay a certain amount.
To like a credit card or a car payment,
house mortgage, those kind of things. And so you take those payments and you add them up for a month, and let's say they're $400 on 3 different loans or whatever it is, and then they're making that $1,000. Well, you're going to take 400 and you're going to divide that 1,000 into it. So it's your debt to income. So that's the way it is, just a quick division. And so whatever that percentage is, that's what we base our approval off of typically. I mean,
what do you have to be at? Is it 1.25 to 1.3?
No, you're talking commercial.
Yeah, debt to service coverage ratio.
So debt to income, typically 40% is where you start drawing your line, because the rest of their income is going to go towards food, gas, electric bill, cell phone, that kind of stuff. So whenever they start reaching that 40% level, not to say that we say, oh, you're we're not going to approve you, because that's not what we do. But it's something that's kind of the threshold that you start really looking and analyzing.
It's an indicator that you start getting concerned.
And then you look at credit history and credit score and those things too with a consumer loan. Not that you don't on a commercial loan, but that's something that you look at, because a credit report's kind of broken down into 3 different areas as well. You've got your revolving debt, you got your installment debt, and then you have your mortgage debt. And so typically you watch people how they repay their debts, and that kind of dictates what their score is. And so a lot of people that get in financial trouble, their revolving debt, they let it go first, and then the installment debt would be second, typically in most situations, and then you see a mortgage that would be foreclosed on or something, and you know that they're really underwater. So, because everybody needs a house to go to and live under and all that, and typically people need their cars to drive to and from work and do the things they need to, but the other spending that's
the discretionary spending,
unsecured debt, those kind of things, those are things that they
credit cards
may have gotten out of hand on. And you never know, it could be some kind of a situation. Every situation is different, but it could have been a situation where they had, medical bills that they had to pay, or something along the lines that was out of their control. But a lot of it is within their control. They just got out of hand and spent too much money. So
I feel a little weird here drinking just lemon water today. Usually we have a little whiskey or a little beer, but be a little conservative with it, with the conservative bank. What can I say? But that's a good explanation that I think a lot of people miss, right? Mm-hmm. So credit score and then debt to income ratio. What's the other considerations you have for personal lending?
I mean, just knowing your customer too, and knowing their character, and the capacity is your debt to income, and then obviously we want some form of collateral typically on most loans, and
so break that down. What collateral do you need, and what's the ratios, and what do you consider is collateral?
Well, I don't know that I have a hard and fast rule for different ratios on collateral. It's just, if somebody's going to borrow $10,000 and you want something that's worth at least that or more, because if you had them default on the loan and you had to go basically repossess your collateral and try to sell it to recover what you'd loaned them, you kind of want a little cushion in there. So I don't know what that margin typically is. I mean, each situation we analyze and evaluate the 5 C's of credit, and we want to understand each one of them and make sure.
What's the 5 C's of credit?
Well, that's going to be character, collateral, capacity. You're going to get me on the last 2, condition, and I can't think of the last one, so you may have to edit that out of this.
We're going to keep that one in.
Yeah. but those are the things that we look at whenever and it's easy to do that on a consumer loan because you know the person, or you can know something about them, and so and then the other parts are the things that
so it is a relationship based business.
Oh yeah, for sure.
I mean, you got to have the fundamentals a part of there. You got to have good credit, and you got to have a wherewithal to be able to pay back the loan, right? And there's a lot of rhetoric, especially nowadays, that says, hey, don't have any debt. I think that's a very ineffective use of capital. I think debt's a good thing if it's managed correctly. Yeah,
it has to make sense. Everybody would love to be debt free, but I don't know what the percentage would be, but probably 85% of America is under debt of some sort, if not more. And so it's hard to do the things that you want to do, because not everybody's got a pile of cash they're sitting on just to go do the things that buy cars, buy houses, those kind of things. And so it's just something that you have to manage, and it's something that you have to understand, and budgets are real big within family households, and that also helps with the things that you're wanting. I always try to break things down in wants and needs. You need it, or do you want it? If you need it, it's something that you have to have, then you're going to have to figure out a way to make it work. If it's a want, well, then you need to say, hey, if I want this, is there a way I can get that? Do I have the cash to do it? Yeah.
Or can I sacrifice something else to get it?
Yeah. What can I do differently to make this? And a lot of people, their wants, they go and borrow money. Well, when they get out of hand with that, that's whenever they get in trouble. But, you know, a good budget and within a household and a family, and everybody understands it and tries to follow it, sure does help.
You want my budget breakdown?
What is it?
Oh, it's very easy. So most people say that you shouldn't spend 40% more on your mortgage, right, than your income. Mm-hmm. I believe it's 25%.
Okay.
If you're 25% on there, right, then you're going to spend roughly around 20 to 25% on taxes, whether you see them or not. They're there. Sales tax, federal income tax, right? So you're 25%. If you're a high net worth earner, then you're at 40, right? Yeah. But that's a whole different story. And then you got tithing, so giving, right? It's 10%.
Well, charities and those kind of things, sure.
10%. And then you turn around and you're going to play on 10%. And then you're going to save 15%. And so then you have about 5%. Did I do my math right? Somebody check that math, but I think it's 5% left over for playing. So if you stay within that mindset, I'm not saying it's perfect. It's never perfect with anybody. But the problem is I see people, the house is always the problem. You know, they buy a house that they want to grow into, but they also want to grow into that budget to afford the house. Yeah. And so it ends up being 40, 50% of their income. And that's where it really, and they're waiting for a bad month, bad year, bad quarter, whatever it is. And they unwind a lot of progress. And so if you live, it's the funniest story I've ever had. As I sat down with a guy owns amazing pieces of real estate, and he's worth about $500 million. And he built this house that's like 30,000 square foot, immaculate house, gorgeous. And I asked him after living in it for a year, it took him 3 years to build it. I go, was it worth it? And he goes, Brandon, after 6 months, you walk by that $1 million mantle, and it just becomes a house. Yeah. There's really not that difference. And so I've looked at it differently personally, and also for my clients, is I would rather have multiple houses for the experiences than having one big house. Sure. And I'd rather have a quarter or $500,000 or $100,000 house in 3 different places, on a beach, on a lake, in my primary residence, in the mountains, than I would have one big house, right? Yeah, for sure. Does that make sense?
No, I've had that same conversation with my wife, because we've talked about that. You know, having 5 kids, we couldn't have a small house. We've got a larger home, and now they're all moving out, and so we're trying to figure out what our next move is. And we would like to have, you know, some of those other options possibly if it's in the cards for us. And so, but yeah, going back to that, you know, people, they become house poor.
Yeah, they really do.
And that's the term that really speaks for it. So they go out and they buy this house. Well, they can't do anything else in their life because they're strapped with a mortgage that every month they're having to kind of watch their P's and Q's and make sure they can make that along with their other debt and also live just a standard lifestyle.
And life stops being fun.
Well, yeah, it's like you can't. The friends say, "Hey, let's go out of town for the weekend." Well, we don't have the money to go do that because of other things. So
then it goes on the credit card, and the credit card debt starts piling up, and then you're paying 20% interest, and it's a snowball effect.
Snowball effect, exactly. Yep.
It's crazy. That's a great analogy there. It is house poor, and that's what it is. I would say that's the biggest deal, and then the cars are probably the second.
Yeah, I've always thought of a vehicle as one of the
worst investments.
Well, it is, unless that's your office. And I've got some guys that are salesmen, and they said, "Hey, I don't want to be in a little bitty car running around. I want to be comfortable. I drive a bunch and those kind of things." And I understand that, but again, it goes back to needs and wants. Do you have to have that $80,000 pickup, or will a $45,000-$50,000 pickup be just as serve its same purpose? You know, I mean, that's something that I think is one of those things that people need to evaluate in their situation. And if it's something that you want that and you can afford it, man, get after it.
Or you budget for it.
Sure.
And you sacrifice other things to do it, to get there, right? And I have a ridiculous, I lived on hand-me-down cars when I grew my business as long as I possibly could. I lived in the smallest house as long as I possibly could. I lived in our first house we ever bought for 15 years. Yeah. Everybody thought I was nuts for not upgrading there, but now it's propelled me to the ability to have the liquidity to be able to expand my business. That we're in a great position now, right? Yep. And so I think living below your means, I've never heard of anybody going broke living below their means.
Sure.
And that's the coolest thing inside of it. So, but back to the car deal is I had to make a choice because of taxation to buy a higher end luxury car that had autopilot, which I absolutely love. And I actually bought back my time, not because I was on the autopilot and doing stupid stuff, but it freed me up from sending a text message or having a phone call where I could focus on the road, but I felt more productive, and I felt like I gained the money I paid on that car. So it kind of goes back to your story of saying, hey, if your office is your car, right? It's no longer a luxury; it's a necessity at that point in time to a certain degree. So I think that's a lot of deals. So switch gears on me a little bit here, and let's talk about my favorite part, which is business lending. Yeah, right? So business lending is a whole different area, and it's a whole different animal, right? And so if you start a business, there's multiple ways for you to get lending. And the one that I think people don't understand is SBA lending. It's a very difficult one, right? I think there's a lot of hoops to jump through, a lot more, and you end up with 2 loans. And then there's also the regular conventional C&I lending, real estate lending, stuff like that. So let's break some of that down a little bit. So let's talk with the SBA. So if I'm a new business owner, been in business, how long do I need to be in business? If I started a business to even get a mortgage, how long do I have to be in business to get a loan? This goes back to Tom Kuchar's with Texas Tech Federal Credit Union's conversation.
As far as being business, I think they, and of course you're talking about a mortgage, and they.
But typically you got to be in business 2 years.
2 years, yeah. That's what they like to see. Have a 2-year history of that. So yeah, that becomes a challenge with people that own their own business, and they're still, they walk in, they start a business, and they're wanting to buy a house or whatnot. Well, they may not qualify at that time just because of the rules that are associated with a mortgage. And so,
but isn't that on commercial lending too? I got a guy in here he's knocking down $400,000 a month in net earnings, but he's only been open 9 months.
Yeah,
and nobody will touch him.
Well, history does mean something.
It does,
and I don't know what that amount of history is on a
commercial. It goes back to a
commercial
relationship, though, right?
Well, for sure. If you know the person and you understand their business and you see the potential there and you believe in them, I mean that to me is something that you may be willing to go bat for them, whether it's 2 years, 18 months, or a year. If they've had extreme success and you see that they're going to continue that same success, or the likelihood is there, well, then you may hook your wagon to them. But at that point in time, that's when SBA comes in, because SBA kind of, I guess it
what's SBA stand for?
Small Business Association. And so what that does is they come in and they got several different programs that small businesses can qualify for, and what it does is it minimizes the risk to the bank. And so the way I would explain that is, let's just say that you came in, you started a business, and you needed to get a new computer system and some equipment and stuff like that within your business. $50,000. Been in business 6 months. I show good profits each month, this, that, and the other. I've got a little bit of liquidity and capital in my business, but I don't want to use all of it because I'm still growing, those kind of things. Well, through the SBA programs, some of them are where you'll put a 10% on whatever that loan is, and then we'll loan the difference, and we get a guarantee from SBA to where if you defaulted and we had a loss at the end, they would pay back a portion of that back to the bank, and so that's the way that would work, depending on what the percentage of the guarantee is.
You said something that's really important there. So on a commercial loan, what is the typical community small business lending requirements for small business owners to put down? Isn't it 20%?
Well, and it depends on
the program and what you're trying to do, right?
Sure, but yeah, a bank typically on equipment and things, real estate purchases, things like that, 20% is kind of where a bank starts at. Now you've got some more aggressive lenders that may do 15, or some that have done 10, but 20 is where it starts. I've even seen some have a kind of a standard of 25%, and what it is we just want the person that we're loaning the money to have some
skin
in the game. I mean, that's all there is, because they're part of that that relationship too, and so that's part of the deal on that. So,
but it was a good point with the SBA because of the small business aspect of it. They're going to allow you to do only 10% down instead of 20 in some cases, in many cases. So your capital up front that you have to put down into the business, because you are a small business getting started, you can put less capital in order to actually grow your business. So sometimes that SBA loan makes sense.
So SBA is just they're the government put them in business to make it to where a bank would make it more advantageous for a bank to want to make a loan, because they're protected from that aspect, as long as whatever they've taken for collateral on that business loan as well. So yeah, the SBA's got many good programs. Percentages down, it just is going to vary based on what the request is, but typically with SBA, your down money requirement, down payment on whatever you're trying to purchase is less
than a conventional.
And then
commercial
the
loan.
bank sees less risk there with SBA being kind of partnering.
So let's put this all together, right? So you're talking about, let's hypothetically say that it's a small business. My watch just went off. I apologize, but hey, breaking news here. So we'll get off that. But 10% is going to actually go to the lender, the lendee, right? The business is going to pay 10% down. The SBA is going to cover 40% of it. And then you're going to back up the difference of 50%. So for the bank's standpoint, y'all's risk in an SBA loan is only 50% to the asset value of what they're lending to.
Now that scenario you're talking about is typically on real estate loans. So if you're purchasing real estate, they've got some programs out there. There's a 504 program, and then so that's what you've basically described there. So yeah, so initially let's just use you for example. Let's say that you came to me and wanted to borrow money to purchase a building, and you're kind of new. You've been in the business a while, but now you're ready to get out on your own. You're wanting to start kind of your own deal, but same kind of business. So you're not really recreating the wheel with something. You're still doing the same thing you've been doing, but you're just maybe becoming independent or breaking off or doing something like that. And so let's just say that it's $1 million to purchase this building, and you've got some money set aside. You're financially strong. You show to have good earnings, those kind of things. And so, what we would look at on that, since there is a little bit of a not concern, but just you're still young and growing and those kind of things. We may say, hey, let's go this other route and let's use SBA. To kind of assist us on this, because you say, hey, I got this much cash, but I don't want to use all of it. I'm willing to put in, how much are y'all going to require, basically? And we say, well, if we can utilize this program that minimizes the risk to the bank, we could probably do that. And I think they require 10 or 15% down, where a standard bank may require 20 or 25% down. Everybody's different. And then, yeah, that's what we do. You fund it, and then SBA comes in and they take out a portion of that. It's typically, I think it's up to them, but typically it's like 40% of that. So you've put in, say, 10%. They take out 40 of it and they set it up. It's still a loan through them that you still have to pay back, but it's not with the bank. And then the bank has a 50% loan in that same scenario that we're talking about. And with that 50%, the bank has first lien position too, and so that's the other advantageous.
So I want to talk about first lien position, because I think that a lot of people don't understand that, but let's also talk about the difference inside the structure. So inside the structure, you put 10% down, 40% hypothetically goes to the SBA, and then the other 50% goes to the commercial bank that's backing it. So there's actually two loans, and I think a lot of people don't understand there's two loans wrapped into one loan package, and that the SBA loan in many cases can be stretched out longer as far as an amortization schedule than what an actual community bank loan typically does.
Also, the rates are fixed for a longer period of time on the SBA portion, which is more of a fixed cost for the customer.
Yeah.
The bank's going to probably fluctuate their rates over 3 to 5 years. It may reprice during that time.
And explain what that means, right? So repricing, let's say I have a 20-year commercial loan with you. You're repricing what the rates are every 3 to 5 years.
It's based on how it was set up and how the term was set up. But yeah.
So how do you reprice those rates? What do you use to reprice those rates?
Well, typically you're going to use an index like Wall Street Journal Prime up front whenever you negotiate the deal and set up the terms. So it may be Prime plus 1, and at the time we close the deal, say that's 6%. I mean, I'm just throwing out some numbers.
Right, but I'm giving an illustration for people to go see. So they can Google Wall Street Prime, and they can see what the current rates are today.
Yeah. And that's what Prime is short-term rates, and that's what the Fed's been moving here lately is all of your short-term rates, and you hear about rate increases and hikes and those kind of things. But so anyway, let's go back to the scenario. Say we make the loan, it's at 6% because it's prime plus 1, prime's at 5, so one over that would be 6, and we may fix that for 3 years. And at 3 years, if it reprices, it's going to go back at that point in time at the market and see what that index sets at what's prime setting at that time, and it's still going to be the same prime plus 1 for the next 3 years. Or if it was,
but the Fed rate or the prime rate could be lower or high.
Correct.
Why do y'all do that? Because it's the cost of the lending from the Fed, right?
Well, not only that, but also we're repricing deposits all the time too. Most people come in and do a 1-year CD. Well, after 1 year, we don't really know what the rate's going to be. So our margin could go up and down too. And so we're constantly repricing deposits within the bank, whether they're going up or down. And then and that's what we're basically loaning out, and that's all based on how all the markets are working. But then Prime's going to kind of follow that too, as far as that goes. And so we're just trying to stay consistent with the way that we
what the current market is
with that, and then what we've agreed to do with the customer.
And I think that's a very important point, right? Because that could go both ways. So if interest rates are going up and you're in 3 years and you're getting repriced, you're going to get a higher rate on your interest rates that you're paying into that current existing loan.
Correct.
But it also goes the other way. And I beat you up a couple years ago. And I was like, no. Prime's way down, right? So we're going to reprice this and go lower. And you did that for me. Yeah. And I think that also attests to the character of the bank that you're working with, and also you as a bank lender, is that you did reprice that lower for us, right?
Well, it was the anniversary of the
3,
whatever we were setting at. I can't remember. But
if it was 3 years or 5 years, I can't remember. But that's typically what the scale is. It's every 3 or 5 years, right? That's the rhythm that banks reprice their amortization schedule, and that's what that's called, is an amortization schedule, right? It might be 20 years, but you're repricing that loan every 3 to 5 years as you're going through that 20-year cycle.
Yes, that is correct.
Yeah, and that's really neat to illustrate and to actually have a great conversation with people, because I do not believe a lot of people understand that. And so here's how it could go bad. So if you're sitting down and you're financing $1 million building, and you're looking at it, and it was 2010 or 2014 or whatever, the interest rates are at 2%, right? And you're pricing that loan at 4.25% on prime, right? And then all of a sudden we're in 2023.
Yeah.
And now it's at 7 or 8 or 9. You could get a stark difference in your monthly payments.
Oh yeah, for sure.
Right? And so I think consumers need to understand that interest rates matter. Debt matters.
Yeah.
And so as you're actually going through these loans, when you're talking to your banker, I think it's great to keep that relationship with your banker, even though it's a loan that you're taking for 20 years, and you might have it not need a conversation with you. Like, I'm fortunate that I'm in the industry that me and you talk on a personal level, but also on a professional level, pretty regularly, right? But most, I would say, how often do your guys have a conversation with you? Once a year, maybe?
No, it just depends on the business and what their needs are. I mean, you'll have some that will, talk to you on a monthly basis based on what their needs are, and you'll have some that, you do talk to once a year. It's probably kind of similar to your business in some aspects with some of your clients. I mean, there's some that probably need you more. And there's some that say, hey, I'm just going to let it ride for a year, and we'll have our annual or our quarterly meeting or semi-annual meeting. It's the same kind of deal, but I don't necessarily set those up with my customers. But we always go out and check on them, from time to time, or place a phone call or do those things. Just, it goes back to that relationship that we were talking about.
That's just because you're a good loan officer.
Well, and a lot of people use that relationship deal, and it gets thrown out there a bunch. But honestly, when people are proud of their businesses, and when they feel like their banker comes out and looks at what they're doing and the things that they've accomplished and what they've put together, I mean, they appreciate that. And so it's not something that, the banker's like, yeah, we made a big loan, and I don't care if I ever talk to that guy again. That's not what it's about with me and the guys that I work with. They want to stay, connected to those people.
Sure.
See them grow, and then there's going to be other opportunities, or referrals are big too. So they say, hey, this guy really helped me do this. I see that you're doing that. Go see my guy.
Right.
And so we've
like in my business. Yeah, you do a good job, you then get referred in.
And we've built a lot of as far as commercial business and residential business and consumer stuff off of referrals. And that's to me one of the best compliments that somebody can give you if they refer you to somebody. So
yeah, it's absolutely. So we covered debt to income ratio on a consumer side, but it really kind of flips over to debt to service coverage ratio on a
business loan or commercial loan, debt service coverage ratio, DSCR, yeah, and it's really the same kind of mathematical
equation,
similar, yeah, but you're not. So let's just throw some numbers out there. A business is going to have, gross sales of X amount of dollars. Say they make $1 million in gross sales. Well, then they got to take out all their expenses out of that.
Cost of sales, cost of goods sold, COG, right?
Well,
30% comes off the top typically in a business unless it's service. So you're down to 700.
Yeah, and so then after 700, you got to take out all of your just monthly expenses or annual expenses, like payroll, advertising. I'm trying to think of just other things that would fall
utilities, right?
All of those kind of things.
Services, computers, right? Taxes.
And so at the end, let's say that you're down to like $200,000 after you do that. So we started with $1 million. We have what it cost us on what we were selling or what we were doing. So we get all the way down to the bottom. We're at $200,000. Okay. Then you say, what kind of debt do they have that they're having to service monthly, quarterly, annually, however that business is set up, and however the cash flow is how you set up their debt as well. But so you take that and then you really compute the same kind of deal, but you put that in there and you figure out how many times that $200,000 can cover their debt that they have, that they're obligated to pay, and that's your debt service coverage ratio. Now, everybody wants to know what's the magic number there. Well, you at least want a 1-to-1 for sure, because you want to know that whatever their income is can service what their debt is. But at the end of the day, you don't want that net income number to be zero. Yeah, right. You want it to be something. And so that's what you look at whenever you're analyzing that credit.
Typically, I say it's 1.3. So you want 30% left over after you pay all of your service.
Well, it depends on the banker. I mean, some of us want 2, 3, 4 times.
Forster.
But we don't always get our way.
Yeah, you're getting your way on that one. 1.3 to 1.5. I mean, we do acquisitions. Like you know this, right? Like we do acquisitions a lot. So we're trying to acquire other financial advisor firms. And so we're looking at it from a 2, right? So I want to be able to cash flow that advisor's acquisition and have 2 times the debt. I mean, 2 times the income to the debt that I'm getting, right? And so that's the point you were making, right? And so that's one of the major thresholds we look at, because if that advisor exiting, right, in a year, 2 years, or 3 years, or 5 years, I got one that's fixing to exit in 5 years. If he's looking at exiting and something happens, the market changes and it pulls back, and we get a COVID event, or we get a 2008 event, and those assets devalue by 20, 30, 40, 50%, I need to make sure that I can cover, right, my income. And that's why I have to stay at around a 2, because if I get a 50% decrease in my assets, I still have enough to cover that debt.
Right.
Does that make sense? And so not only from a business standpoint, from a business owner standpoint, these are important calculations that we consider and we look at. And that's what I really think there's a disconnect in society today, because I think that information is so apparent, but a lot of people don't have that information, and the big companies do. I mean, we talked about this before we get on. It's like you looked at ChatGPT yesterday came out with version 4. I mean, it's insane how artificial intelligence, and it is already baked into the publicly traded companies, but it's not in the small businesses. And so they're operating in such a disconnect and so behind what larger companies are. I think there's an opportunity for both community banks and also guys like me to come in and fill that void where we can sit down with these guys and go, look, if I can educate you in 15 minutes and 30 minutes or in 3 years on how to operate your business more efficiently, can you be more successful? And I think there's an opportunity there to do that. So that's my rhetoric for the day. But I think it's neat because I've seen what's fun about my career. It is with yours too, right? How many guys have you met that own businesses they're so different in how they created wealth?
Oh yeah, everybody's got their own model that they've managed to make something work with.
Yeah, it's the American dream. It's the definition of an American dream.
Sure.
And it's like me and you worked with a lot of farmers, right? Me and you've worked with a lot of business owners. And so everybody makes wealth in a different way. But I think the numbers at the end of the core of the day are the same, but they just get there differently.
Yeah. You know, speaking of farmers, and I've got several that I work with, and you know, those guys are salt of the earth folks. I mean, hardworking, just, you know, great people, and they typically want to do what's right and do the right thing. And the things that I've learned with them is some of them, they know their business front and back, and they know I can hand them a package to fill out for their next year, and they'll take it home and knock it all out and bring it back to me where it makes my job. I just look at it and I'm like, okay, have a few questions, but then I kind of know what they're going to do for their next year for their operating loan. And then I have some that are like, man, I hate filling out paperwork. And so I'll schedule an appointment with them. We'll go through it together based on comparison from last year to this year. I think that helps them.
Yeah, that's just basic service that you're providing that nobody else is providing. That's just being good at what you do.
And then just explaining the things of, you know, like their net worth. Did it go up from last year to this year? You know, what does their current ratio look like? And what do we look at from our standpoint to approve their loan? And what looks good and what are areas that they may need to focus on to do something different with? And so to me, I've got two kind of people there that some of them understand it. They've done it for so many years. They say, give it to me, I'll go home. And they're kind of anal sometimes, so they want to do it all themselves. And I've got some that says, please help me. And it's not that they don't know their business well. They would rather be out there on a tractor doing something else rather than doing paperwork, working on a computer. And you know, it's like my nephew. He's a young, beginning small farmer, and I've helped him a few times, and he said, man, I don't know how you do what you do. He said, I couldn't sit behind a computer every day. I couldn't do this. And I said, well, it's something that I've been doing over 20 years. And so I understand it. I enjoy it. And you know what he enjoys? He likes going outside and getting on a tractor and turning the soil over and doing the things, planting stuff and seeing stuff grow. And so it's just, to him, it's just based on, you know, what you like, what you do.
Way guys gravitate towards what their passion is. It's such an awesome thing. And we need every single aspect of that in America today.
Oh, yeah.
Because it's getting really, really rough. Let's talk about farmers for 2 seconds, right? Okay. Do you think in today's society, the way that they've like farming 25, 30, 40, 50 years ago, like you could go buy a tractor, lease some land, buy some land, put in a crop, and you can make a living. Do you think that is today?
You can't without help.
No.
I mean,
it's impossible, isn't it?
Yeah. Somebody couldn't just come out of college or high school or something and just start their own farming operation.
Why? What? Let's break that down.
Oh, there's several factors. I mean, number one, typically they're not going to own any land, and so they have to find it. Well, to find land's tough because most
water's
farmers,
a huge commodity, and so it's going for a big price right now.
True, and if you're right out of high school, you're not going to qualify.
Or even out of college, right?
You're not going to qualify for a loan to purchase land. But so you have to rent land. Well, most of it's already rented. So how are you just going to walk in and say, hey, I want to rent some land? You can't. So either somebody has to go out of business, retire, something like that, gives you the opportunity to come in. That's obstacle number one.
But let's assume you have that, right?
Okay. Number two is you have to have the equipment to farm it. And so
that's the problem.
I mean, it's super expensive to purchase that.
What do you think a round baler, and I'm talking about cotton here, what's a round baler cost?
$750,000.
That's insane.
Yeah.
That is absolutely a problem. So my point to bringing this up is let's look at what's fixing to happen. It's fixing to go to corporate farming. And I think that's going to be a huge problem with what we produce in America, because there's no longer fixing to be the next generation is not to be family farmers anymore.
Well, I don't know when that's going to happen. I mean, they've been talking about corporate farming for years. I mean, ever since I started in banking.
I got to give you pushback on that one. Like, you used to be able to buy seed for $35 a bag. Now you're buying seed for $600, $900 a bag?
Not that high. Probably $400. Yeah.
Yeah, I mean,
there's a big difference, but there's a lot of technology in that bag of seed too.
Right, and as soon as the federal government allowed patents inside of cottonseed or inside of food, that's a problem. Now, there's good and bad to that, and I want to make sure we identify both, right? So the fact that we changed the way that we could produce seed and actually patent seed now created yields to go up dramatically.
It has. And precision agriculture is the other thing that has, I guess,
Explain what that is.
Well, it's just they've got, with technology, they've got planters that put so many seed in the ground so far apart. I mean, yeah, it's a bag of seed's going to plant however many acres,
right,
just based on the way the technology of the planter works and the way it's going to plant. This bag's going to plant 2 acres or 3 acres or whatever it is, however you set your settings. And so back whenever I was a kid, my dad's a cotton farmer, and we had that cheap seed that we had. Well, if you spilt some of it, you didn't care. Now you're like, every little seed, you're going to make sure it goes in there. It's like, that's one of those things that you don't want to lose. But
I hope you got the right angle on that one.
You moved it right to your angle, right as the.
That's great.
But no, it would be very hard. So what you see second, third, and fourth generation farmers that have just come up through the business, and they've just kind of
that's what I love.
Inherited.
I just think inherited farming for small families is going to be harder and harder.
Yeah, well, possibly. I mean, but they've had to continue to grow. I mean, if you're buying equipment that we talked about, $750,000, well, you got to spread that out over a bunch of acres. You can't do that on what they used to be able to farm, 160 acres, and you can make a living growing it up and all that kind of stuff. Well, that doesn't happen anymore. You got to be 5,000-6,000 acres, just to justify it. And that may not even happen too. You may say,
yeah, but look at West Texas. Like, that's common here in West Texas.
Yeah.
Is that common in the Iowa states?
Well, no. No, theirs is typically not as large. I mean,
what's the difference? What's the dichotomy there?
Well, you're talking about different commodities,
but the price of the land, right?
Well, the land is higher there too.
Way higher.
Yeah.
Like you can get land here for $1,500, $2,000 an acre, and that's well irrigated.
The market's gone up more than that now. But
what is it today then?
Well, it just depends on where you're at.
2,500, 3,000?
Yeah, possibly. I mean,
but what's it in the Iowa states?
I couldn't quote that.
I did a case 4 years ago, and they were $30,000 an acre,
really?
$25,000 an acre. That's crazy. So they were living on 300-400 acre farms, and they can make this work. And what the difference is there, I think that's really relevant. And here in West Texas, we get, 16, 18 inches of rain a year?
We hadn't in the last few years, but yeah, that's typical average.
Yeah, right? Up there, you're getting 30.
Yeah.
Right? So it's easier to grow things up there where you have to be more irrigated down here, but yet water's a problem here.
Yep.
And so I think there's a compounding factors that it costs more for seed. The input cost is way higher. Now we got Russia that's going to war here that produces 80% of our fertilizer. Where's that? And it's up 1,700% in the last 2 years. We had Rodney Mogan on, which is one of the largest landowners in the United States, that hedged that because he has 3 PhDs and 41 financial designations, and he knew how to hedge it, right? Most farmers don't. And so I think there's a problem there where now the input costs, right? And then you have people that are the tax benefits of your Schedule F in farming is dramatically good. And so high net worth people are gravitating towards buying farms just for tax benefits, which is not a problem. I don't fault business owners for doing that. I don't fault high net worth people for doing that. But it squeezes out the smaller guy. Does that make sense? So I think there needs to be a change there where you're not getting mega farms. I mean, I got a mega farm up north with dairies and things like that own 150,000 acres of farmland. Right. And the barrier to get into farming, I think there needs to be a fix there. And I don't know if it comes from the banking standpoint or if it comes from the government. I hate government coming into it.
Well, the government's always been involved in agriculture from some aspect. And, if you talk to some of the farmers, they would prefer to make a crop every year and not have any type of a subsidy or not. They don't like having that, I guess, if you want to call it a handout. But, again, they pay their fair share of taxes every year. They spend their money out in the economy that they live in, and they try to, give back to things. And they're having to constantly purchase equipment and replace things and do those kind of things. So they feel like they're doing their part, but a lot of times the markets, they don't control. And so they can't just go out there and say, well, you're going to have to give me $1 for my cotton. They're kind of a price taker a lot of times. Now they can go out there and do some marketing and whatnot, but a lot of them are busy doing other things that they don't focus on that, and a lot of them aren't educated in that. So there's certain type of pools and things like that help market that for them, and on an average, it turns out to be typically in their favor for most aspects. So, but man, I don't know. There's so many aspects to the farming sector, as with many sectors in business. And
there's variables and risk and everything you do, right?
And so
that's the sector that scares me the most for my kids' generation.
Well,
if we can't produce food, if we can't produce things in our own society, then we're liable, or the risk for other countries is to produce it for us. Like, I mean, I just came back from Costa Rica. And I will tell you, the thing that I noticed in Costa Rica compared to the United States that was really troublesome is 6 days in Costa Rica, I felt better eating their food.
Really?
100%, without question. And I really think there needs to be a change in the way that we produce food here. Just like there's actually a term for food grain corn and non-food grain corn. Because there's such a different disparity in that, and such a capitalist that I am, that's a problem. And when I went down there and I ate their meat and I ate their vegetables, and it was so much more fresh, and it was non-tampered, that I felt better. My energy level was better. My digestive system was better. And I came back here and it took a whole 1 day, and I just didn't feel as good. And I was like, man, they're onto something here. But it's hard to feed 300 million Americans on what we produce here in the States. Yeah. And so I really think, hey, Ryan, Harrison, can you look up what the population feeds 300 million Americans today?
Like what percentage?
Of the farmers today feed all three, and I think it's like single digits.
It is a single
digits. Yeah, it is. It is.
And that concerns me, and I don't think it used to be that way. You know what I'm saying? And so, and I don't know that for a fact, but I think that's where banks like you, right, what I do, that education piece to allow them to make sure that we keep it in small families, we keep it where we're growing good things at a fair price. And the spread between the people that work their tail off to grow it and the people that are making money to deliver it to the consumer, there's a lot of money to be made in that spread.
Yeah.
And I think hopefully technology, not only on producing, like you said, precision farming, GPS farming on these tractors, right, with green and red steel that runs around on these farms, right, has gotten more precise for us to produce higher yields. But it also needs to work more into the favor of where I think the cattleman, I think the farmer can go to market direct, and they don't have to go as directly to a middleman, and we don't have these conglomerate corporations in between it. And I'm a capitalist. I'm in the public markets, right? But I think there's an opportunity there, and I hope somebody else actually solves that problem where they can go direct and provide a better product to the consumer at a cheaper rate with higher margins to the people that actually produce it.
Yeah, what you're saying makes sense. I don't know that we're ever going to get there, though. Honestly, now you may have some markets of certain commodities that you're able to do that with, but some of these others that, your grains and your cottons and those things, I don't know that it's ever going to get there. Now, if you specialize in some type of an organic or something specialized that they're doing with some form of the commodity, then maybe you have like a niche market there that you could utilize. But I don't know that on a wide grand scale that we'll ever get there. But as far as going back to, how many farmers are feeding America, food and fiber, it's dramatically down. But again, we have to have those people, and America needs to understand that we have to have those people. Just because you go to the grocery store and you go get a bag of potatoes or some milk or whatever, a lot of people think that's all they have to do. Well, they need to understand where it came from.
Sure.
And so if we were dependent on another country to provide that, we don't know what kind of standards they're held to. Here in America, we're held to a standard of something. So we have to produce those.
Who holds that standard? It's USDA, right?
Yeah. And so you got these standards you have to meet. And so with that, we're trying to provide the best foods and things like that within what we can afford to grow them at to America. And so I think that's why the government will never let agriculture fail, because we don't ever want to become dependent on some other country for that to provide for Americans here.
Did y'all find that stat?
Yes. So the average one American farmer feeds 155 people. In 1960, one farmer fed 26 people.
Yeah.
All right, so we got to say that because he doesn't have it again in a mic. We're gonna have a secondary mic set up for Harrison here. So. Yeah, it's not set up. So
he said one farmer feeds 155 people today. And what year was it?
1960.
1960.
26 people.
Yeah, one farmer would feed 26 people.
That's crazy.
Yeah. So
that's absolutely nuts. So hats off to the farmer.
Yeah.
Right? I think they need to be the wealthiest guys in the country.
Well, you got some that have done very well.
Yeah, they have.
And
right?
you've had some that struggle. So it's like it is. It's like with any business. You have to have a good business model, put it together, and
you got to have a good businessman.
Yeah.
No matter what industry you're in, you got to have a good businessman. But I think that's a great stopping point, man.
Okay.
I appreciate you coming in. I think that's a great
good talking
podcast.
to you. Yep.
Yeah, absolutely. So see you next time.
All right, man.
You think come back on?
Yeah, maybe.
Was it as bad as I thought? You thought? No? Right?
Yeah.
Good. Awesome. See you, buddy.
All right.